Hello, everyone, and thanks for joining me. Today, I'm going to be talking about a presentation I made for Canadian Heavy Oil Association. Unfortunately, there were some IT kind of like slide issues. I think I later on realized that maybe the clicker was too sensitive because it will skip a couple of slides. So I had to freestyle it a little bit for the presentation. But nevertheless, it was I think it was well received, and there were people that I really admired that were at the event, and I really enjoyed some of the conversations there. And so I'm looking forward to sharing the whole slide deck from what I prepared, and I think it could be useful to everyone that's kind of involved on X and LinkedIn, and just who kind of cares about this topic, to see where we go from here when it comes to heavy oil, past growth, present reality, future potential. And this was part of my talk in Canadian Heavy Oil Association. So the importance of Canadian heavy oil, mainly it's from one perspective, is in the concept of reserves. So as of 2022, world oil reserves, you can see here Venezuela 17%, Saudi Arabia 15%, Iran 12%, and Alberta within Canada is 9%. Now, over 90% of that oil is Canadian oil sands. And on the right, you can see 80% in situ, 20% mining. So out of those reserves, and we're talking about 170 billion barrels, something like 135, 140 billion barrels will be in situ. And the main difference is that in situ barrels, you cannot really mine like you would mine at surface. So you will use trucks to mine the oil sand. So you will take that sand and the oil that's saturated within that sand and process it and remove the water and remove the sand and sell the oil and then refine it. You cannot do it in situ because it's just too deep to mine. And so that's kind of one of the angles, is the opportunity associated with Canadian oil reserves when it comes to past, present, and future is fairly significant, and that's why it's important to address. The other angle here is that Canada is one of the top global producers of crude oil, including least condensate. As of 2023, Alberta was producing similar amount of rates to Iran, China, Iraq, but Canadian population is nowhere close to the population of those countries. And so Canada, Alberta, plays an important role within the broader kind of oil production rates. You see US 16%, Russia 12%, Saudi Arabia 12%. And so Alberta is right there. Now, when it comes to partitioning of the production oil rates, you can see that raw in situ bitumen, there was significant growth from 2020. And I will speak about why it took place. But also we see growth in raw mine bitumen and other crudes, as you can see in the chart on the left. And we're close to 5 million barrels per day oil production rate. But 70% of Canada's oil production is the oil sands, right? Where the partitioning is basically 50-50 between the mined bitumen, so surface mined bitumen, and in situ bitumen. And my talk will focus mainly on the in situ bitumen because, just like what we said in the previous slide, majority of the in situ of the reserves are in situ. The 80% are in situ reserves, which is the in situ bitumen reserves, where production right now is about 1.7, 1.8 million barrels a day, and about to increase to 2 million barrels a day. So the main driver, the technology that drives the recovery scheme for in situ production is the SAGD technology. And on the left, you can see the way it works. You will have injector well, so you inject steam through that well, and production well at the bottom. And what you really want to do is inject steam so you can heat transfer the enthalpy that carries that heat essentially to downhole, transfer that heat to the oil, and drain it by gravity. So that's why it's called steam-assisted gravity drainage. So you can basically produce the oil, which is as hard as a hockey puck and too deep to mine. As you can see, way on the ground. It could be 300 meters, 400 meters or so. And that pressure could be 3,000, 4,000 kPa, right? And so you got to inject that steam in steam conditions, transfer that heat, and produce that oil by gravity. And this is the core technology today that's utilized for in situ production. The inventor of this technology, his name is Roger Butler, and he developed this concept in the late 1970s, but the concept was commercialized in the late 1990s 20 years later, right? So one common theme that I hear that people complain about, the technology development takes a very long time in our sector, but reality is the core technology, which is SAGD, took many, many years and 2 decades to develop and commercialize, and then another 2 decades to really to bring it to 1.7 million barrels a day while we're still optimizing on this concept. And you can see he is working on some kind of pressured vessel there. We're trying to kind of maybe optimize some VAPEX process complementary to SAGD, which is vapor extraction process, where non-condensable gas could be co-injected with steam to maintain the bottom hole pressure in those reservoirs. And so he's been working very early on that, and we see huge implementation of non-condensable gas utilization in our current reservoirs. And the steam chamber development in SAGD, solvent processes, non-condensable gas processes, is really a function of equations of state that we utilize. So often we will use Peng-Robinson equation of state, but here I put a very simple one. It's PV-nRT, so ideal gas law. And in the presentation at the CHOA event, there was there was a presenter, his name was Chad. He talked about that every smart presentation should have some kind of equation, and this was my kind of equation version for that. And this is kind of derived from Boyle-Clapeyron equations of ideal gas law, but let's kind of focus on what it really does here. So P stands for pressure, right? So pressure in situ, you already have built-in pressure because of that height of the chambers, where it's located way underground. So 300 meters, 350 meters, 400 meters. And so the pressures, as I mentioned, could be as high as like 3 MPa, 4 MPa. Now you have the concept of volume, which is V, where you inject steam. There is a displacement mechanism, but you also need to pressurize. And over time, as you develop the steam chambers, as you can see in this picture, you grow those chambers, but you need to inject more and more steam over time, which increases the steam to a ratio. And that's why non-condensable gases utilization is taking place, to basically reallocate the steam. And that's kind of what we're seeing in the industry. And so the industry is also busy with the amount of substance that's being injected, basically steam. And that's one of the core challenges, is that you don't have infinite steam. Steam is coming out of somewhere. That somewhere is basically our ability to utilize the surface facilities to create that steam. And there is significant capital that was invested into the facilities to create the steam, so it can be injected to reservoirs, so oil can be drained by gravity. And so a lot of the assets, if not all of them, are constrained by that steam. And so in my presentation here, one of the kind of my theses was to showcase that, look, you can steam to SAGD is what fracks to tight shale formations. You are limited by that steam capabilities, and so you have to do additional things to bring production online at a faster rate or increase the production oil rate. And that's really a function of your steam utilization. The other component here is temperature, which you utilize at vapor pressure conditions to drain the oil by gravity. And so if you think about this, if you inject steam into something very with high pressure, that steam could turn into water right away. And so physics allow you to calculate the amount of enthalpy required to be injected with steam injection rates that reflect him of maintaining the steam conditions in situ. And so guys like me, this is something we do, but this is something to be mindful of, is that all of those parameters are very important in growing the steam chambers. Those steam chambers could be as high as 30, 40 meters. Very often, let's say in Saskatchewan, that could be as high as 20 meters. But this is something very important to be mindful of, because the industry is really driven by some constraints. You can't grow infinitely, because you don't, by definition, have infinite facilities to generate the steam, and those facilities are costing money. In addition to that, there is some lithology associated with reservoir parameters. So for example, we could have a sandstone that could have very nice permeability, very nice porosity, very nice thickness, as I mentioned, but you can have other geologies that could be in those reservoirs, like breccias, NDIHS, MADIHS. So those stands for inclined hydrolithic stratifications. And those really are like muddy dominated beds or sandy interbeds or muddy interbeds that are not necessarily good for reservoirs. They're almost like ceilings in the middle of your reservoirs, and they limit basically steam chamber growth. They could result in no heat transfer to upper levels of the steam chambers. They can also hinder steam chamber development. So those are the things companies are also focused on these days. Different assets in situ recovery schemes, they also will have different morphologies to the asset. So if we took an aerial view, which is what you see here, you can have different sites that have different type of configurations, different types of development programs, different types of kind of geologies and kind of geographic locations that could hinder development in some areas and maybe benefit development in other areas. For example, you can have like a river or something like a lake. And on the left, you can see 30,000 barrel a day or so ISOR 3.5. This will be Kirby North production. So you can see morphology of that asset on the left. So those will be smaller kind of modulated, I would say, assets. And then you see assets that like Christina Lake of Cenovus, so ISOR about 2. This is, I think, from January 2025, where I extracted this data for the monthly SORs. And so what you see basically here is different configurations. And so what we see on the left is something that we see a little bit more of now when it comes to greenfield development. But on the right, there's no more greenfield development of those type of assets of 200,000 barrels a day, 250,000 barrels per day. But we're seeing the cases, and I will talk about them, of assets that develop assets for 6,000 barrels a day. So for example, Cardinal Redford will be one of those assets in Saskatchewan. The other one will be International Petroleum Corp, a Blackroot asset that develops at closer to 30,000 barrels a day. And this will be something similar to what you see on the picture on the left. And talking about steam, for example, steam utilization, as you can see, the steam to oil ratio could be different for different assets, right? So it could be 3 unit of 3, for example, steam to oil ratio in some assets. It could be 2 in other assets. But that's really a function of utilization of that steam and capabilities of the steam. For example, if steam to oil ratio was 10, you will need 10 barrels of steam to produce 1 barrel of oil. But if you have a steam to oil ratio of 2, you need 2 barrels of steam to produce 1 barrel of oil. Now, this becomes really important because as you build this facility, which is the capital up front, before you produce any oil, it's important to consider what that steam is going to give you. This really translates to the concept of whether you need in tight oil formation, like maybe 10 fracs per well or 20 or 100 fracs per well. And this will be also material when it comes to the OPEX side of things, operational costs. But in this case, that steam utilization has become somewhat infinite in the sense where you're going to be producing this asset for 10, 20, 30 years. And so the SOR metric becomes really important from that perspective because perpetually, regardless of oil prices, you will need that amount of steam to produce that amount of oil. And so the lower the SOR is, the better it is for the companies. Okay, so at my talk at CHOA, I wanted to show this graph. I was not able to show, but my key messaging here was that this sector is extremely volatile. And as you can see in WTI prices, post great financial crisis in 2008, 2009, oil significantly crashed. But then we saw a wonderful recovery from 2009 or so towards 2014, 2015 timeframe, which is in the green rectangle. And oil prices were very close to $100 per barrel. So this environment created a lot of kind of optimism from management teams. So if you're like an executive in 2011, 2012, you're saying to yourself, wow, I can produce more oil. I can invest more in CapEx. I can build more steam generation facilities, and I can really like build off of that and cash flow in the future much more than I am today because the reward is there because we're $100 oil. So companies were able to take the cash flow, free cash flow, the concept that didn't really exist during that time frame, and purely allocate that money towards oil production rate. And what we saw later on around 2015 is the exponential growth basically in tight oil formations in the Permian, in the US, mainly in the Permian. And what you see is United States essentially becoming one of the most important global oil producers in the world, which they were not previously. But then the OPEC policy was forced to change due to those events. And what the Saudis essentially did at this point, they said, okay, we will kind of compete from economic perspective, and we will introduce more barrels to the market, And what you see happened following that event is oil prices essentially crushing around 2014, 2015, 2016 timeframe, where we go to about $40 per barrel. And there were times that we will go to 60, for example, in 2018, 2019, but then we will go down. But the context, and obviously this ends epically with COVID at minus 37 WTI prices, as you can see in this chart. And this rectangle is really the era where there is a shock in the industry. The industry looks back to their previous assumptions. They do not believe kind of what's taking place. But because you need to generate those facilities that create steam to be injected, and the handling facilities at the back end, the basically emulsion and gas facilities that need to handle that oil and basically produce that oil, now you're basically stuck because the capital is already deployed and you're way into it. This will be very similar to thinking about buying real estate, and then you basically take HELOC to borrow to put a down payment on another apartment and another apartment and another apartment, and you grow your real estate portfolio. But then you get a crash in prices, and now you're basically levered to your initial investment, and then you can't even break even on all of those as you're trying to rent those apartments. And if you were to divest of those apartments, you will be losing money from your initial capital investment, in a sense, right? So at the end, we end up basically going into 2022, mid-2022 timeframe, where Russia attacks Ukraine, and oil prices really spike towards those levels. But we did see recovery prior to that war, to initiation of that war, I guess, by Russia, where oil prices recovered from negative prices. They basically, you can see the purple line here where we're currently at around 59 WTI. And these prices kind of allowed cash flow to the companies to survive, and while the stocks were significantly hit during COVID and during the downturn. Now, the red triangle, the red rectangle also represents significant amount of layoffs in the sector. So for many years, there were layoffs, there were programs that were canceled, but some assets were able to bring production online still because of this initial capital investment. And of course, today they probably get rewarded, which kind of makes this topic a little bit controversial, because we saw, let's say, MEG Energy investing significantly during the green rectangle timeframe, growing their production significantly to today it's about 111,000 barrels per day. This company that gets acquired now for about, I would say, 8.3, 8.5 billion, depends on how you look at it. So this was 600 million in debt and another, I think, like 7.5, 7.6 in equity, depends on how what timing you use. But they were basically building into the red rectangle timeframe, and the stock got hit significantly around 2015 because there was a leverage on the books when it comes to debt, and their solution was to be low cost of supply on from the bottom, not to spend too much money so they can survive the time period. So a lot of thoughts come to mind, and obviously I'm spending a little bit more time that I had during my CHOA talk, because I'm making a YouTube video now, but that allows me the opportunity to speak about those concepts a little bit more, so you can kind of maybe learn from it or comment or have some views of maybe they contradictory to my views. And so during the greenfield capital boom in the green rectangle, well, even regardless, that capital growth was significant, but then over $300 billion was invested between 2000 to 2023 into the in situ sector and the mining sector to bring production to where it is today, which is close to 5 million barrels a day. And obviously 70% of that was that oil sands development, mining and in situ, and huge capital investment. And just for comparison, and I did talk about this in my talk, is that if you look at Canadian Natural Resources, which is one of the biggest oil companies, natural gas companies in Canada, their current market cap is about 100 billion. Suncor Energy, their current market cap is 75 billion or so. Cenovus Energy, their market cap is about 50 billion. And if you add all those together, which will be like close to a 3 million barrel a day oil production rate, you do not get 300 billion, which was the investment, the capital investment, the significant investment into the sector that we saw between 2000 and 2023. And large projects include Foster Creek, Christina Lake, Curl, Firebag. So all this capital went into those assets that today generate the significant free cash flow that we talk about often. And production essentially doubles from 1.5 million to over 3 million. The projects we've seen, the 2 to 10 billion projects, and some of the capacity on some of those assets were over 40,000 barrels per day capacity. These assets, by definition, because those are steam generating assets with very high life reserve index, those are long duration, exposed to and they're also exposed to commodity cycles. So you kind of need to be low cost of supply during the entire time as you produce those assets. Okay, so let's look at some examples right now. If we go back to the oil production rates, you can see here, right? So, oil prices, and we're going to see soon some examples of oil production rates. You see the green rectangle, so 2009 to 2015, and red rectangle, about 2015 to 2022. So very important time frames, oil prices high and oil prices low in red. And let's see what kind of happens close to those time frames. So Cenovus Energy Foster Creek, so production today is close to 214,000 barrels a day. And what you see here, basically, they keep adding phases. So, and then in the red rectangle, you see the steam, which is the red line. We're looking at the red line right now. It's kind of plateauing a little bit with some optimizations. And obviously, there's some events, curtailment. There's some trading off spec issues, as they say here. There's some phases that being added around 2015, 2016 timeframe, which is really deep into the kind of recessionary environment. But you also see in yellow line gas injection. So that will be NCG co-injection. So what this speaks about is that you're still growing your development of your pads, but you do co-inject non-condensable gases to maintain the bottom hole pressure in those reservoirs while maintaining the steam production that plateaus, but oil production rate is able to increase. And there was a comment by at the conference by Tom Gear from MEG Energy. He mentioned that not everything is about home runs. The current development in the sector is really about singles and doubles, right? So the home runs were during that huge growth time frame, as you can see, between, I would say, 2005 to maybe 2016, 2017. But then the steam generation or steam ability to generate steam or injection capabilities through boilers and OTSGs and like all that stuff, you basically kind of plateauing, but you're still able to produce significant amount of oil. And so on the asset, you don't really see a decline, which is kind of very representative of Foster Creek. And so what people talk about when they talk about long reserve life index that's very long, or resources, or the fact that assets just don't decline, well, this is a great example of that, right? And so they're able to maintain really good SOR, steam to oil ratio. I think it's close to 2.4, 2.5 right now. But they also utilize significant amount of technology, as you can see, using NCG injection. So non-condensable gas co-injection. You may recall that I talked about the PVNRT, where pressure, volume, temperature, and the amount of substance plays an important role. And so there is this dynamic between steam injection and NCG as late life pads come online. Another example here, Suncor Energy Firebag. So this is one of the more important projects. Shelley, at the conference, Shelley from Suncor, she is the executive VP. She says that Firebag is their crown jewel asset for Suncor, and I agree with that. You can see here, so we're currently at 250,000 barrels per day. This is just over 40,000 cubes on this chart. And oil production rate has been somewhat steady here, I would say between 2015 or so. So, somewhat steady in the time frame to 2015 to 2023, 2024. But again, we don't see huge home runs, but we see singles and doubles, because they're able to kind of optimize the bottleneck, do turnarounds, do maintenance, but the overall steam is not increasing as significantly as it did between 2010 to 2014 or so, highlighted by the green rectangle. And so significant investment was made to generate those injection capabilities of steam generation capabilities. put boilers, OTSGs, treating facilities at the back. But guess what? They did very well. And you can see significant growth in well count. So well count is increasing from basically just under 50 well pairs to about 330 or so on the chart. But what they did do very well in the gray chart, they utilized NCG injection as well. So they utilized non-condensable gas injection. Therefore, the steam injection rate in overall stays in that range. It's not growing significantly like in this previous time period, but they're able to do the singles and the doubles, not the huge home runs. But it's still good enough because the production currently is 250,000 barrels per day, and they're still optimizing on this asset. That's why they're very proud of it. And so if you have such an asset, 250,000 barrels a day, I mean, this is, we've all seen Suncor's performance, at least in their stock, and Rich Kruger, kind of turned around that ship around, which is significant, and generating significant free cash flow. But that capital that was utilized 10 years ago is kind of being decayed a little bit through generation of free cash flow, paying down debt, buying back shares, paying dividend, and all that. So this company is doing extremely well, and I think it speaks to the importance of those assets for those companies. Now, as we talked about NCG co-injection, you would notice that I mentioned the gray graph here is injection of that non-condensable gas. But look what happens here. They're telling us that on vast majority of their legacy well pairs and pads, they in fact inject significant amount of non-condensable gas co-injection that has been implemented on the following well pads at Firebag. So 101, 102, 103. And what this speaks about is the coalescence of those steam chambers with those pads and their ability to inject NCG. It doesn't condense, so it's non-condensable, and it allows pressure maintenance in those chambers. Now, the main driving mechanism, though, for those chambers is the steam injection, because that's what transfers the heat to produce oil by gravity. But then you have a challenge of the steam chambers basically coalescing, growing, and you don't really, as you develop like steam chambers vertically, you don't have as efficient of a heat transfer, so your steam to air ratio by definition is going higher. And this technology really helps them to maintain steady steam injection rate, but growing the asset and developing better geology, as you can see in basically red pads. So here is another example of one of the biggest assets, and by just to put this kind of in context, I picked those assets because those are the biggest assets in Alberta, and they're around 1 million barrels a day from the sample that I talked about, which is 1.7. And so I think those are very important to consider. So what you see here, you see growth in Christina Lake. So Christina Lake now is going to be kind of merged with Christina Lake for MEG. That just got acquired by Cenovus. And you can see here, again, significant growth in the green rectangle, somewhat plateauing steam injection rate in red. So during that time frame, oil prices were challenging. And oil production rate goes just similarly to Suncor Firebag to 250,000 barrels per day or so. And again, in yellow graph, they utilize non-condensable gas co-injection in yellow graph, in yellow chart, yeah, and able to maintain bottom hole pressure for legacy well pairs while reallocating the steam to new pads. What's really interesting in this time frame is that phase F and phase G, as you can see on this graph, it seems like it comes online a little bit later. And they actually talked about this in 2012, 2011 AER disclosure about phase F and phase G amendments, and in 2011 approval for phase G and phase F. And so it came online in 2017. And my key message to the audience at the conference was that, look, these are very complex projects. They take time to develop, they take time to design, they take time to put things in place. And those are not trivial, especially on this scale. And so we have to be mindful that not only when you go on such projects, not only that it takes significant capital, it also takes time. And that's why during the downturn, we didn't see holistically in Alberta and Saskatchewan big projects being advanced from a greenfield perspective, and mainly kind of add-on brownfield projects. So here now, let's talk about MEG Energy Christina Lake. So MEG Energy just got acquired by Cenovus, and we see a very similar story. during 2014, 2015, 2016 timeframe, we see significant growth in steam capabilities. So phase 2B was very important to them. But at the same time, this growth, this capital was spent going into a downturn, right? And so it was very challenging to be MEG in MEG for that amount of time because because you kind of invested that capital, you grew your oil production close to 100,000 barrels per day from maybe 30, 35. So on this chart is about 5,000 cubes a day. So that will be about 30,000 barrels a day. And now you bring it to 100,000 barrels per day at SOR 2 to 2.2, 2.4. And you basically can't cash flow as much as you assumed between when oil prices were $100 a barrel, which is very complex and kind of not intuitive, I guess, because now you kind of your assumptions were not really realized in a sense. And so this speaks again to the huge uncertainty we have now going forward when it comes to bringing those type of assets online. And the question is, at $59 oil, are we going to see those type of phases coming in where you need to spend significant amount of capital to advance these programs? And so my message to the audience was, my view is that what we're seeing now is basically the status quo, where we do see some greenfield development on some of those projects that are somewhat smaller, but we don't see greenfield development on like the mega projects like what we've seen before. And this is a good example in phase 2B. And again, consistent with the messaging for the other assets, look at the yellow graph. The yellow graph will be basically gas injection, so non-condensable gas co-injection, maintaining bottom hole pressure in legacy well pairs, legacy pads. And ISOR is basically sustained, so that's very good, instantaneous steam to oil ratio. But the producing well count is continuing to increase, which tells you they're continuing their development program. They producing good geology assets. They continue the growth, but they utilize NCG for late life pads and kind of maintaining that steam utilization that's not necessarily increasing at the same rates, even though around 2021, 2022, we saw increase in steam capabilities going from 30,000, 35,000 cubes a day to 40,000 cubes a day. So that will be another small phase. And they communicated in their previous quarters here, their intention is grow to asset to about 130,000 barrels per day. So now they're about 111, so another 20,000. And there was some communication between the kind of Cenovus acquisition and all those conversations that maybe they're going to grow this asset a little bit more. But this remains to be seen as this entity kind of continues to expand and MEG Energy Christina Lake becomes North Christina Lake as part of Cenovus. So this site is called ConocoPhillips Surmont, very close to my heart. This is from public domain, by the way, so we just speak into those charts. And again, you see the same kind of story, significant growth between 2015, 2016, 2017 timeframe, as you were designing the plans in prior years to get that scale. But obviously very challenging oil price environment, as we saw in the chart, with OPEC policy kind of bringing oil prices down. And you can also see in purple chart, NCG utilization to maintain bottom hole pressure at late life pads. And steam injection rate, which is in red, is being sustained because, again, you're constrained by your injection capabilities, boilers, OTSGs, steam generation, essentially. And the production doesn't decline on the asset, but the steam is being reallocated accordingly, as you can see in this chart. So another smaller assets I wanted to talk about is Athabasca Oil Hangingstone asset. This asset is so today they will produce close to 9,000 barrels per day, but there are some fascinating facts about this, and it really speaks to the power of in situ production using the SIGD technology. So what you see here, if you look at this kind of brownish line, it's called, it represents the well count. And the well count on this asset did not change really between 23 well pairs to 25 well pairs. So well pair will be like injector producer, well pair, so injector producer, where injection you inject steam, and production you produce oil and water, and then you basically treat it and inject steam back. And so this is intriguing because it's a smaller company. Again, the stock didn't do really well during the downturn, as you would expect, but then they had this really nice recovery. But look what happened to the oil rates. The oil rates trickled down slowly and slowly. They were able to co-inject NCG, so you can see there in the purple line, NCG co-injection. And SOR, steam to oil ratio, declined significantly from, I would say, 5.5 to about 3.5, 3.4. And guess what they did recently when oil prices were a little bit higher? They drilled 2 new well pairs. So now the well count is, I think it's about 27 well pairs. And that production that came online is additional 1,500 barrels per day. So they were able to restore back to 9,000 barrels a day, going down to about 7,000. But that happened without drilling any new wells. And obviously, we're not even going to talk about steam capabilities or steam generation capabilities or any additional capex, because oil prices collapsed, and so they had to basically survive. And what we see here in the steam is opportunity for the technology NCG co-injection to create a wedge, in a sense, of steam injection capabilities that could be utilized on new wells. And so all these companies are kind of doing that right now, which is very intriguing. So this is something I wanted to share with the audience, is that this is kind of where the opportunity is to reduce emissions, but also to kind of optimize your assets. Now, their configuration for Hangingstone asset, which is what we just talked about for Tabasco Oil Hangingstone asset, looks like this. So they basically have kind of like forks type of shapes, right, where the different pads are kind of merging almost together. So when they co-inject non-condensable gas, it kind of moves across the pad. So maintaining bottom hole pressure becomes extremely important, super important. At the same time, you run very low risk of maybe that well short circuiting into your electric submersible pumps. And this is kind of intriguing to me because it's not a typical configuration. And the 2 well pairs they drilled, there, because of the innovation in basically well lengths and the completions and all that, it's much longer wells, and therefore they produce a little bit more, well, much more than a typical well would. And so average interval distance between the well pairs will be 100 meters. One thing I mentioned, that the opportunity is also in drilling new infill wells. And my understanding was that maybe that's kind of something they could be doing in the future. So in the industry, we have well design, length trajectory, flow control devices dealing with complex geologies. You can see injector and producer picture on the left. You can see very complex different geologies. For example, yellow could be low permeability, low porosity, IHS kind of regions. And you could maybe close a flow control device via flow control device and output of steam to the reservoir of steam in those sections and control that a little bit better. So the industry is becoming really good in those type of technology developments. Also, all these interbeds, IHSs are very kind of challenging and very heterogeneous in a sense. And so companies are doing a good job trying to kind of go into cleaner pace and a lot of advancement from that perspective. And therefore, as we go forward, those assets are not becoming more homogeneous in a sense. So because you're better off like drilling a nice pay wells early on, because it's less challenges, less operational challenges, but there's real opportunity in kind of optimizations as we go forward. So that was kind of my key message. Also, companies drilling infill and redrill wells integration. And on the right, you can see an example of that. So you could have different steam chambers developing. You can see the temperature of the steam chambers in the picture on the right, but they could be in very different shapes. So what you could do, you could drill or redrill a producer to the midsection where you do have heat transfer, and that oil can be drained by gravity without an injector. You could also do that kind of if you land a little bit lower or to the side, right? So we see a lot of that where companies are trying to optimize that way. And also a picture on the left, you can kind of see the holistic kind of teardrop shape where the heat has been already transferred, and you can recover that oil from that section and produce it to surface. One project we do see that's very intriguing, and I share this with the audience, is the International Petroleum Corp Blackrod project. This project has 259 million barrels of resource. The capital expenditure is about 850 million USD. There's some local expertise in SAGD operations from people that operate this. The expected production for phase one is 30,000 barrels per day. And that kind of gives you an equation that in Canadian dollars, from development point of view, a flowing barrel will cost something like 30,000 per flowing. Now, MEG just got acquired for over 80,000 per flowing, and in the past we saw assets such as this one getting acquired for just over 60,000 per flowing. And so what they say here makes a lot of sense to me, because the upside is $1 billion for 2C resources, what they kind of communicating there. But also from NPV10, you're looking at 1.4 billion USD, right? And $50 USD per barrel WTI break even. And so that makes a lot of sense if you have unique situations when you can greenfield develop something with smaller amount of capital. You could monetize that and make money doing that. But we just don't see it on like the mega projects, like the Firebags, the Foster Creeks of the world, like we saw 20 years ago, because that capital is essentially is not allocated for that purpose because of price volatility. And because companies are busy buying back shares, paying down debt, and pay dividends. But the Lundin's been very successful in other areas of business, right? In mining, in this type of endeavors. And so they're able to do this with significant backing and advance a greenfield project and monetize it in the future, potentially. And if they don't, they will just cash flow this asset through the various cycles, because significant life reserve index, as shown here from their slide, when it comes to resources of 259 million barrels development. But how did they become, how did they got to this point? So this is something also important to talk about. So what they've done between 2011 to 2023, they basically had pilots. But their timing was very interesting, because as they were ramping up, you can see steam injection rate in red. As they were ramping up steam injection rates, they got oil production to about 100 cubes a day on the well pair and kind of produced that over time. But then they got into this low oil price environment. Now, this is not necessarily IPCO. This is Black Pearl, the legacy company that the IPCO acquired. My understanding is that they ran this pilot to develop the greenfield project there. But there was this kind of natural extension for over a decade now to really test the geology, understand delineation, understand the strat wells that kind of been drilled, and what the geology looks like, but also test, what kind of production you see from wells. And so 2011, they constructed the Black Rod facility to start well per 1, 2013 commission well per 2, 2015 shut-in well per 1, drill complete well per 3. And so what you see now, well per 3, producing about 100 cubes a day. So that will be 630 barrels a day or so, maybe 650 barrels a day. But nevertheless, they go ahead and scale this operation, and now building what I shared in the previous slide, a project on this lease to produce 30,000 barrels per day in that phase, greenfield development. But again, in the context of this industry producing 1.8 million barrels a day from SAGD in situ, we don't see huge projects coming online, and this will be one of the bigger ones. So in summary, okay, so major capex already deployed. As you saw, significant growth in steam generation capabilities, boilers, OTSGs installed, the assets expanded brownfield expansions. They've done a lot of kind of smaller, singles and doubles instead of giant home runs. But the company is really focused on the balance sheets as well. And many of those assets, they already paid off the initial capital. Therefore, they're in post-payout status. So as you saw also from my charts, asset decline is not really a thing. Steam reallocation using NCG co-injection and much slower phase growth is what we're seeing. We're going through a phase where we see shift from greenfield to brownfield optimization. Not everyone's doing that, obviously, but the players that do that, they just don't have that scale where you can grow production by 1 million barrels a day or so, right? So we're not seeing like big projects. And I think this is really important because we hear a lot of conversations about pipelines and expanding pipelines. And so the concept there is kind of like, okay, well, let's say you get a pipeline like a Enbridge mainline, 3 million barrels a day. Okay, But it's almost looks like impossible to fill that pipeline in a timely manner if the companies don't shift their kind of in-house policies for growth-oriented kind of production. Of course, the government would love that, but I just it's very challenging for me to see how do you build a big massive pipeline and fill it also as well. So I think from that sense there needs to be somewhat of a synergy between those projects and maybe them working in parallel, so then production can meet the pipeline and pipeline can meet the production. Otherwise, all that political nonsense talk is just not realistic. If you get production, if you get pipeline, for example, some expansion on TMX or Enbridge pipeline by 200, 300,000 barrels a day, I can see how this could happen through brownfield optimizations and those little projects at 30,000 here, 6,000 there, where we can achieve that. But otherwise, I think it's just kind of political nonsense. A lot of focus from the industry is on NCG, co-injection, infills, redrills, new designs, debottlenecking, and complex geologies, as I mentioned, because the Permian is not only experiencing complex geologies. We also see that in Canada. And so guys like me basically go in and optimize those assets and deal with those complex geologies. Capital efficiency prioritized over volume. We see a lot of that. Investors demand returns, not just production. Investors demand buybacks. Investors demand dividends, less debt. We do see smaller players that able to grow via modular design, so very small modular design. I showed one example of that in IPCO Blackrod project, but also Cardinal, a referred in Saskatchewan. They're going to produce 6,000 barrels a day. At least that's the plan. My understanding, the SOR there should be a little bit higher than 3 based on kind of initial paperwork that was submitted to government. But nevertheless, those are intriguing projects. But again, if you start kind of aggregating them, they're not that big from overall scheme of things, but they're good for the companies that operate them. So that's really good. Now, in the conference, I also heard Athabasca Oil talk about their corner asset. So this is by far the cleanest asset when it comes to its geology, the upcoming greenfield development asset. Really nice permeability. I think it's like 6-7 Darcy. Really nice porosity, oil saturation. Beautiful concept, very close to Christina Lake type of environment, and 15,000 barrels per day. Again, for them, it's going to be material. For the sector, maybe not. So within that context, I think it's important to put things in perspective. And obviously, as I mentioned, if you develop something for 30,000 barrels per flowing, 30,000 per flowing, there's this kind of hedge to the Strathcona Serafina Energy Saskatchewan model, where the asset value, the cash flowing and producing, could be north of 60,000 per flowing. And with MEG, we saw a price of 80,000 per flowing. And so now we're starting to get kind of this environment where you can rank things based on quality of the asset and say, this is 60, this is 80, but the development is 30, right? So we see some assets that trade maybe at 40,000 per flowing, which maybe provides an opportunity, considering those assets could be actually cash generating and not, invest too much money in the kind of asset itself. That could become a challenge. Obviously, it's a very dynamic environment, lots of kind of moving parts, but hopefully this graph helped you to understand a little bit more. And this was my closing chart at the conference. And obviously I had only 15 minutes. I would have gone it in 15 minutes. I spent a little bit more time here explaining a little bit more to the audience. But at the same time, we see the West Texas Intermediate crude oil price and NYMEX confidence intervals on the short-term energy outlook. And again, I don't know how this could be super reliable. Maybe it is, but oil prices right now are close to $59, $58. So it's not that unrealistic. But the confidence in the interval doesn't give us any confidence, right? We see price that could be as high as $100 per barrel. We see price that can be low as $40 per barrel. So there's not much confidence in them. But that's not the key message. The key message is for the viewer to think about this concept and think about, okay, but these oil companies also see this type of confidence intervals and this kind of short-term outlook. So is there an incentive to grow infinitely and build greenfield facilities? And my answer is no. There's no much incentive. And that's why my message was, we understand the past, which is what I presented today. We understand what's present, what's currently going on. And the future, I think, in the next couple of years looks a little bit like what I described so far, which is unique greenfield opportunities on case-to-case basis, but mainly brownfield optimizations, with majority of the capital being allocated towards buybacks, dividends, debt reduction, especially with those type of short-term energy forecasts, where it's very difficult to invest capital if your cash flow kind of projections are being challenged in a sense. And so that's really my key message. So hopefully you guys like this talk. I'm trying to do my best to advance education on SAGD, mainly from a technical perspective. I really appreciate everyone's support over the years, supporting Razor Oil on Twitter. And thanks everyone that ever comments or does something nice for me. I really appreciate that. And hopefully you enjoy this talk about current status and where we're at in the cycle. So again, this is my, I always share this disclosure that I'm not really providing any financial advice or any add-on. I'm a guy that's specializing in something, and I like sharing information and advancing education on the topic. So hopefully you enjoyed it. But otherwise, I wish everyone all the best, and thanks for your time and comments on the topic. I appreciate it.